Good morning, everybody. Welcome to this webinar, which will be dealing with the tax deductibility of expenditure related to broad-based Black economic empowerment spend. By way of introduction, my name is John Jones, and I am a director in corporate and international taxation. I'm based in the Johannesburg office of RSM South Africa. So let's start firstly to look at the nature of B-BBEE expenditure. And this really flows from the previous webinar that we had during the course of last month. It was presented by Zahn Albrecht. And really in looking at this, it's quite important for us to understand what the nature is of the type of expenditure that happens during the course of broad-based Black economic empowerment expenditure. And really what we see is four main categories, and many of you will be familiar with these categories. The first of which is skills development, and that can be either both internal, in terms of the development of your internal staff, or external. Secondly, we have enterprise development, which really is where we spend money to help develop enterprises that are not part of our own supply chain. Then we have supplier development, which really falls into enterprises that are part of the supply chain. And then lastly, our socio-economic development spend, which really revolves around the corporate social responsibility. So starting to look at tax deductibility of this expenditure, and I think the next two slides are probably the most important in the context of this particular webinar. Firstly, we need to understand that there are no specific provisions in the Income Tax Act around B-BBEE expenditure. So there is nothing that deals with this type of expenditure in the specific sense. So when we are in that situation, we then are required to go back to our general principles. And there are some specific sections that potentially could apply when we start to look at the type of expenditure that we are incurring. So in that situation, we really have to revert back to looking at the expenditure that has been incurred and consider whether firstly it is relating to expenditure that's being incurred for our income earning operations, or whether it is relating to the establishment, improvement, or the maintenance of our income earning structures. And this really brings us back to the fundamentals of our income tax law when we start looking at tax deductibility, which is Section 11A, read with Section 23G. Referred to commonly as the General Deduction Formula, Section 11A, read with Section 23G, really states the following. Firstly, it allows for a general deduction. And if, for most of you who are familiar with the expenditure that goes through your entities, this section is applied for the majority of the expenditure that we have in the form of our rentals expenditure, our employee costs, etc. Section 11A is what we are applying. So that is why we refer to it as the General Deduction Formula. It applies to expenditure or losses, and I think that in itself is self-explanatory. Actually incurred. And the term actually incurred is vitally important. It has to be spent. Although in the context of actually incurred, this could also be accrued. So there must be an obligation that exists to make that expenditure in order for it to be considered as a tax deductible expense. It has to be in the production of income. So in other words, you need to be incurring this expenditure in order to produce income within your business operation. And again, a vital component of the requirements of Section 11A. Not of a capital nature, so it cannot be expenditure which is being spent, for example, on plant and equipment buildings, etc. So again, an important aspect of Section 11A is that it cannot be of a capital nature. That is the fundamentals of Section 11A, but that always has to be read in conjunction with the provisions of Section 23G. And Section 23G is quite clear. You must have incurred that expenditure during the course of the carrying on of your trade. So it cannot be incurred for purposes other than during the course of carrying on of that trade. So fundamentally, in order to achieve deductibility of any expense in the normal course, these are generally the first boxes that we try to tick. And this is why I say these two slides in my mind are probably the most important for everybody to understand. These principles are very common within the context of income tax law, and are applied on a day-to-day basis within every business operation, but sometimes are forgotten and are really important when we start considering whether this type of expenditure is deductible or not. Flowing from this, the next port of call is to consider court cases. Now, in the context of this type of expenditure, there have fundamentally been two specific court cases which can be considered when we start looking at this type of expenditure. So the first was a court case, CIR versus Pick and Pay Wholesalers. And really, in the context of this court case, the expenditure that Pick and Pay had incurred was very specifically for philanthropic purposes. So in the mind of the court, it was very definite in their consideration that this type of expenditure would not meet the requirements specifically of Section 23G, in that it could not be regarded as being expenditure that had been incurred in the course of carrying on of a trade. And therefore, in the court's mind, the expenditure that Pick and Pay had incurred could not have been regarded as deductible when we applied the general principles of the General Deduction Formula. The second case is possibly more important and is very often a case that is referred to when considering the deductibility of B-BBEE expenditure. In this particular case, and it didn't relate to broad-based expenditure in the South African context, although Warner Lambert SA is a South African company. And really, in this case, the court dealt specifically with deductibility of social responsibility expenditure. And in this situation, the company that was incurring the expenditure, being Warner Lambert, was the subsidiary of a US holding entity. And the nature of the expenditure that they were being required to incur was in order to adhere to what is known as the Sullivan Code in the United States. Excuse me. Now, this type of expenditure is very similar to the types of expenditures that we see in our South African Black economic empowerment environment, and really is very similar to the types of principles that we see within the codes. And in this particular case, the court was again clear in its finding in that they were of the view that this expenditure was clearly deductible and clearly met the requirements of Section 11A as read with Section 23G. So what does this mean? Two seemingly conflicting answers? Not really. The nature of the expenditure was very different in the two cases. And this is sometimes where, when we start to look at these types of rulings and findings, that there can be some conflicting views and conflicting opinions expressed. But if we start to look at this and re-ask that question, is expenditure incurred by a taxpayer in South Africa for B-BBEE purposes tax deductible? Firstly, why are we incurring this expenditure? And this is vitally important when we consider the nature of the expenditure. And surely, in principle, we are incurring this expenditure to protect or grow earnings. The failure of incurring that expenditure is likely to result in an adverse effect on those earnings in many instances. Although this may not be true in every instance, in many instances, this will clearly be the case. The expenditure cannot be regarded as being incurred for motives of pure liberality or merely for philanthropic purposes. And then if we look at it in terms of the income earning operations, and again, it comes back to that second bullet point, the potential for an adverse effect on earnings, is that this expenditure is so closely connected to the income earning operations to the extent that it can be properly regarded as being part of the cost of performing those operations. The reality is it's necessary in the South African business environment. And everybody who operates in this particular business environment is fully aware of that. If we do not put the appropriate structures in place and incur the relevant expenditure in order to achieve the optimal scoring, it is likely that it is going to have an adverse effect on our business. And it's going to result in us not being able to generate appropriate levels of earnings that are needed in order to make those business operations profitable. Flowing from that, so what is the view of SARS? Now, nobody really knows. SARS doesn't specifically express a view. Sometimes they will issue interpretation notes or practice notes. But in this context, all we have in terms of what we have seen from SARS are certain rulings that have been issued. And I'm going to run through those rulings just to give an indication. And I think it's important to understand that this really gives an indication of the thinking from the perspective of SARS. So the first of these that I'm going to look at is a binding class ruling, or BCR. And it's important to understand the context of the BCR. So firstly, it is issued to a specific class of taxpayer. It is only binding between SARS, the applicant, and the class of taxpayer. And from a SARS perspective, they do not regard this as practice prevailing, and it cannot be relied upon by third parties. So although we look at BCRs as indicative, in a particular circumstance, unless that BCR applies specifically to us, it is not necessarily something that can be relied upon. So the first BCR issued by SARS was BCR 002. It was issued on the 12th of May 2009, so a long way back. And in this particular circumstance, the taxpayer had made a decision to enhance its spend on its corporate social investment. And this was specifically aimed at achieving an improved scorecard. The socio-economic development spend really was providing bursaries to recipients from underprivileged backgrounds. And in this particular case, SARS ruled that in their view, this expenditure was clearly well within the requirements of Section 11A, read in conjunction with Section 23G, and therefore, in the view of SARS, this expenditure was clearly deductible. Now, this ruling has been relied upon or applied by many taxpayers over the last number of years, but it's also important to note that it expired on the 27th of August 2013. So factually, it is not of application, But again, I revert back to well, what is the level of application that we can apply to a BCR in any event? And I think you know, your reliance is limited. It is indicative, and that's the way it needs to be looked at. The second type of ruling that SARS can issue is known as a binding private ruling. And again, when we start to look at the application of a binding private ruling, again, it is issued in favor of the applicant only. It cannot be applied in the general context. Again, it is only binding on SARS and the applicant. And again, it is not regarded as prevailing practice by SARS. And I think, again, we're looking at very important principles that we need to keep in mind when we start looking at these rulings that are issued by SARS. In terms of, well, how much reliance can we actually make on these types of rulings? And if we look at it from the perspective of South African Revenue Services, the rulings are issued based on specific facts that are presented by a taxpayer. And this is why they are very specific in limiting the application of these rulings. But let's look at the binding private ruling that has been issued. So this was BPR 113. It was issued on the 15th of March of 2012 and was reflected as being applicable for 7 years from the date that it was issued. And in this case, the taxpayer put in place an equity equivalent program for Black economic empowerment purposes. And the scenario was that they had identified certain Black-owned and Black-managed independent vendors. These vendors incurred expenditure specifically around their own operations. And in terms of the program, were able to apply to the taxpayer to be reimbursed for this expenditure. Again, SARS were of the view that this expenditure was deductible in terms of Section 11A read with Section 23G. Then we have the most recent. And as usual, SARS is prone to throwing a little bit of a spanner in the works. So this was BCR 072. It's relatively recent in that it was issued on the 7th of August of 2020. And it related specifically to a scenario involving the deductibility of contributions to fund an employee's trust. And based on the facts of this case, and I'll deal with this a little bit further in the next slide, but in this scenario, the ruling that SARS issued is that they were of the view that the expenditure being incurred was twofold, and that portion of this expenditure related to the implementation of the broad-based transaction, and portion related to incentivization of the entity's employees. And based on this, SARS came to the conclusion that 50% of the expenditure relating to that structure was not deductible, as in their view, this was of a capital nature. They came to that conclusion on the basis that they were of the view that this expenditure was of created an enduring benefit. And the second 50% related to incentivization of employees and was therefore deductible. Now, nobody understands exactly how they came to the 50% split, but there is a lot about this ruling that doesn't make specific sense. So if we compare this to the two previous rulings, again, they seem conflicting. So in looking at this, what is our view? Is this type of expenditure deductible or is it not? So firstly, each expenditure needs to be considered specifically, and it does need to be looked at specifically to ensure that you're triggering the points and the requirements around the General Deduction Formula. The BCR ruling in terms of BCR 072, it's different given the 50% split, which really doesn't make any sense when firstly you read that BCR and you understand the facts around it. If we look at the types of BBBEE expenditure, fundamentally there is no real difference in their nature. In the context of the BCR ruling, SARS saw a split between implementation and incentivization. And they seem to consider that the implementation created an enduring benefit. But when we look at it factually, there is actually no asset in the hands of the taxpayer. And therefore, if you revert back to some of the court cases around capital versus revenue, the nature of that expenditure, given that there is no specific asset created, cannot be regarded as being of a capital nature. And then we look at the previous rulings, and those previous rulings clearly support deductibility. So when we look at BCR 072, and I think one of the fundamentals around SARS coming to the conclusion that they came to was that the implementation expenditure was very specifically a once-off upfront. There was no continuous ongoing expenditure related to that. But even in that case, the concept of enduring benefit just does not seem to apply. And there is a very clear case and a very strong argument as far as we are concerned that if we look at the South African environment, we look at the underlying reasons for incurring the expenditure that is required in terms of broad-based economic empowerment, that a deduction can be achieved in terms of Section 11A as read with Section 23G. There are just a couple of other areas that we need to consider just to conclude this webinar. So even where potentially, and this is why, as I indicated earlier, the nature of the expenditure is so important in considering each transaction. But there are potentially other sections where deductibility may be achievable. The first of these are the donations provisions, so where we are expending funds into Section 30 and Section 18A approved public benefit organizations. There is potential for deduction as far as that's concerned. A secondary consideration, if we consider the nature of an expense to be a donation, is to consider whether that donation is of a gratuitous nature or not. But in looking at this type of expenditure and looking at the definition of a donation, gratuitous by nature is, if we look at the dictionary definition of gratuitous, it's something that is not called for by the circumstances, not necessary, appropriate, or justified. It's given unearned or without recompense. It's costing nothing, it's free, and it's not involving a return, benefit, compensation, or consideration. And it is clear in my mind that when we are incurring expenditure in order to achieve certain broad-based Black economic empowerment objectives, that this definition does not apply. So in my view, in virtually every case that we look at, the donations tax provisions wouldn't necessarily apply. Secondly, we do have Section 12H learnership allowances, where you have learners with registered learnerships with your relevant CETAs, and many of you would be applying those learnership allowance provisions. The third one is Section 12I, which deals with additional investment and training allowances in respect of industrial policy projects. Section 12I really looks at providing additional tax allowances for industrial policy projects, which are specifically defined within the section. They are projects that need to be approved by the Department of Trade and Industry, and really covers what are referred to as brownfield projects, which involve the expansion of existing industrial projects, or greenfield projects where we're looking at wholly new industrial projects using new or unused manufacturing assets. And Section 12I was really put in place with the idea of incentivizing industrial development and enhancing skills training, and can provide in specific circumstances accelerated capital allowances and additional deductions around training costs that are being incurred. So again, another section that can be considered. And then, although not necessarily specifically related to Black economic empowerment spend, But something that I think I wanted to just bring in at the end of this webinar is for everybody to be aware of the employment tax incentive. Again, the employment tax incentive was put in place by South African Revenue Services with the intention of encouraging employees to employ young, up-and-coming individuals, and is really focused at employees that fall within the age ranges of 18 to 29, who are earning remuneration of less than 6,500 Rand a month. And there are a number of other qualifying criteria that are set, but in principle, if you qualify to apply the ETI and you are looking at employees earning salaries below 2,000 Rand, you're able to put in an ETI claim at 50% of the salary. If that salary falls between 2,000 and 4,500 Rand, you can claim 1,000 Rand. And then if above 4,500 Rand, you apply a formula, and you're able to make those claims for the first 12 months of the employment of that employee. And then for the second 12 months, you're entitled to make those claims again, but they are reduced in principle by 50%. So that ETI could apply for the first 24 months of the employment of the employee, and is generally facilitated through a reduction in the payroll costs, the employees' taxes that are paid through PAYE on a monthly basis, or alternatively, there can be direct cash payouts. So these are other sections that potentially can assist us in achieving deductibility. But when we look at broad-based economic empowerment spend, that is really generally applied through Section 11A. And in my view, and in our view, in the majority of cases, deductibility can be achieved just by applying that general deduction formula. Thank you, everybody. That concludes this webinar for this morning. As I stated earlier, if you do have any questions, please feel free to put those up in the chat, and I'll more than happily respond to these post this webinar via direct email. Thanks, everybody. Goodbye.